Hey guys, Angel Medina here. On today's video, I'm going to be going over the FHA loan versus the conventional loan. I'm going to be going over the FHA versus the conventional. Now, I want to first start off with the FHA. I think that's important because if you're considering doing an FHA versus a conventional, or you're wanting to know the differences between both of these loans, chances are you might only qualify for the FHA loan. The reason I say that is the FHA loan is really designed for if you cannot qualify for the conventional loan. The reason being is with the FHA loan, it is a government loan and it allows you to go up to higher percentage on your debt ratio and also higher percentage on your loan to value as far as the amount of money that you can go up to on the first loan. Now, typically on the FHA loan, you're putting 3.5% down. What's important to know about the FHA loan that I've seen some other videos on this and I've heard other people talk about the FHA loan, is that if you're going to do any type of government loan, whether it be an FHA loan or a VA loan, you're going to have to, if you're married, you're going to have to use your spouse's debt. So that's really important. Let's say that you both have the same debt, but your spouse has additional debt, you're going to have to use that. Now also, even if they're not on the loan, also what's really important is you're going to have to go off of the lower score between the both of you. So that's really important. If you do an FHA loan and you have somebody who tells you, great news, you qualify for the FHA loan, and you know that you didn't tell them that you are married, they're definitely going to want all of that information, so it's better just to give it to them up front. Another thing about the FHA loan is there's two factors that you have to consider with the FHA loan. The first factor is the upfront mortgage insurance premium. Now, that is something that they do include in the loan. So let's say that, for example, you have a loan for $450, they're going to put the upfront mortgage insurance premium on top of your loan. So not only are they going to give you what you qualify for, they're going to add that upfront mortgage insurance premium onto the loan. So it's not something which I get asked a lot, is it something that I have to come up out of my pocket? No, it's included in the loan. So that is a one-time fee. Now it's charged to you to do the FHA loan. And the reason I think the FHA loan is a great loan because on one hand, you have the FHA loan. And on the other hand, if you can't do any other loan but the FHA loan, then this is a great loan. So it gives you more of an opportunity to do something versus a lender saying, I'm sorry, right now, we can't do anything. So it is a great loan. So you have a one-time fee, the upfront mortgage insurance premium, and you also have the monthly fee, which is the mortgage insurance. Now, typically what most lenders do is once they take a look at your credit and they go over your debt ratio and they realize that you do qualify for the FHA loan, they're going to make sure and go over exactly what the mortgage insurance that they're going to use. There's different providers. On the loan size, it's going to be an average of about $200 to I would say $350 monthly on average. Now, obviously, if you go into the higher loan sizes, $700, $1 million, that won't really make a difference because at the end of the day, with the FHA loan, that's another thing that's really important is every county has an FHA loan limit. So you have a limit as to how high you can go depending upon what county that you live in. So those are two factors that you want to remember. If you do an FHA loan, one is it's a great loan. So don't feel like, oh, I don't qualify for the conventional, forget it, I won't do anything. No, it's a great loan because normally you wouldn't be able to do anything, but now you have a choice. So the first is you have the upfront mortgage insurance premium and you have the monthly mortgage insurance. So FHA loan is a great loan if your credit score is, I would say, below 680 You know, anytime I see a credit score of around like 620 to 660, more than likely it just always makes sense that you're going to want to do the FHA loan, because you're going to give yourself a better opportunity to qualify with the debt ratio. And the debt ratio has to do with, once you submit it to what's called desktop underwriting, it gives us you know, a yes or no depending upon your unique situation. Also, it gives you an opportunity to put less money down, and it gives you opportunity to, even though your score may not be where you want it to be, to have a lower score. So the FHA loan, again, if you are going to compare it to the conventional, then just know that more than likely somebody went over the FHA loan because you didn't qualify for the conventional. Now, what's really important is to make sure that is the case. You don't want to do an FHA loan and have money to put down and have a low debt ratio if you can do the conventional loan. Here's why. I'm going to go over the conventional loan now. So now on the conventional loan, that is a great loan. It's very basic as far as they're going to make sure that your credit score is, I would say, above good, so close to excellent. Your debt ratio, you have to make sure that you qualify with your debt ratio. And what they're going to do is they're going to combine all your debt divided into your income. Now, the great thing about the conventional loan is that, let's say, for example, you are married and your spouse has a lot of debt that you don't have. Well, the good thing about that loan is you only have to use one client. So let's say that you're on title and you have a good score and you don't have a lot of debt. They can only use you, and then that makes it better for you to qualify for that loan. And let's say that your spouse has a ton of other debt. Well, as long as you're on title and as long as you do qualify, they'll just use you compared to the FHA loan. So what the conventional loan is, one, is you don't have, let's say that you only put 5% down with the conventional loan versus the FHA loan. The good thing about the conventional is you do not have the upfront mortgage insurance premium. So you don't have that large lump of money combined on top of your loan. So the FHA versus the conventional, you don't have the upfront mortgage insurance premium, but you do have the monthly mortgage insurance. Now, what's really important is, yes, you have the monthly mortgage insurance, but you want to ask if you qualify to pay the monthly mortgage insurance up front. So sometimes, depending upon if you qualify, you can pay it all out. So let's say, for example, that you have a monthly mortgage insurance with a conventional loan, putting 5% down. Let's say, for example, it's about $300 a month, or you could pay, let's say, for example, around $6,000 to buy it out. So you're going to have to calculate which makes more sense, having that monthly, or if you just want to buy the whole thing out if you have that option. So the good thing about the conventional loan is that you're going to put yourself in a situation to where your loan balance isn't higher, which in turn makes your payments higher. And also, I would say that the mortgage insurance is less versus the FHA loan. So you typically do want to go for the conventional loan, even though you do have to put sometimes more down. Now, keep in mind also with the conventional loan, the pricing may vary, but you can also at times, depending upon if you qualify, put as little as 3% down. But typically when someone is looking to do the conventional loan, they normally will put 5% down, and they'll normally will pay the monthly mortgage insurance. Now, you're going to have the mortgage insurance on that loan, and in order for you to remove it, depending upon the guidelines as to when you do it, you can either remove it when you refinance, or depending upon what you agree to with the lender as to when you can remove it. So again, the good thing about the conventional loan is you don't have to include a large sum of money on top of your loan that you have to pay back throughout the life of the loan. So I would recommend, if you are looking into doing, let's say, the conventional loan, and you do have the extra money to put the 5% down, then yes, you definitely want to go for the conventional loan. The reason being is you're going to have to pay a lot less because typically when you do any type of loan, not only will you have the upfront mortgage insurance premium, let's say with the FHA loan, but let's say for the conventional loan, typically you're going to have also just the fees that you have to pay for to buy down either the rate or any fees that you have to have that are included in the loan, such as title, escrow, and prepaid interest. So the conventional loan is a great loan if you do qualify, meaning your debt ratio isn't too high. You have a FICO score, I would say typically you want to be around 690 or higher, but I'll say 680 or higher. You sometimes can get away with that and still get a good rate. And also you do have a little bit more to put down. Normally when someone is doing a conventional loan, they're looking at putting 5% down. The thing about so now that you know the differences between the FHA loan and the conventional loan, the reason people will normally get told about the FHA loan, or they'll normally inquire about it, or they're going to be told, hey, this is the loan you can do, is because they have their debt ratio is a little bit higher, their credit score is a little bit lower, and they don't have as much to put down. So that's the reasons that you would want to do an FHA loan. So typically, if you're one of those situations where someone will do a conventional with the mortgage insurance included in there, is because they don't want to put 20% down. So, and they have good credit and their debt ratio is low, but they don't have the full amount to put down. So typically they'll do the conventional 5%. Why somebody would do the 5% conventional is because they don't have that large amount of money to put down. And it's just a great opportunity to still put a lot less down and to still have a good rate. But whenever you go do a loan above 80%, well, there is a cost with that. They don't just give you a loan where you're paying a lot less money down. They're going to charge you monthly mortgage insurance. Now, keep in mind, if you do have that loan or you are thinking about, so let's say, for example, you get the loan and then 6 months to a year from now, I would highly recommend to look at refinancing that loan as quickly as possible. So you should look every 6 months on that type of loan, if not like a year, to see if you can remove the monthly mortgage insurance. So that way you don't have to pay more money that's not going towards your principal. So I hope that helps the FHA loan versus the conventional. I think they're both great loans. I don't really feel that if you do qualify for the conventional, that you should go for the FHA, or if you do feel that you can put the 5% down. They both have pros and cons, but they're both great loans as well. It again goes to your unique situation. And the thing that you do want to watch out for is somebody that focuses on doing an FHA loan and they steer you to an FHA loan just because it looks more attractive because it has sometimes a better rate. So you have to be careful. If you have any questions more about the FHA loan or the conventional, you can give me a call anytime. And thank you so much for watching this video. If you're new here, I would ask you to please hit the subscribe button. And next to the subscribe button, you'll notice there's a little bell. Go ahead and hit that bell. And what the bell does is notifies you anytime I have any new videos that I upload. That way you'll be in the know. Let's say that any type of market changes, I usually will upload a quick video going over any market changes that are happening with the guidelines, or let's say with the house values and so forth. So thank you so much for watching my video. Angel Medina, your lifelong mortgage advisor. Thank you.